On the deal I just closed on, I have to pay what's called private mortgage insurance, and this is a extra little mini payment that goes alongside your mortgage. I want to talk more about how private mortgage insurance works, whether it's worth having, whether it should be avoided at all costs, like some people say. Let's talk about that. But before I get into that, just want to introduce myself for anyone who is new to the channel. My name is Jack Duffley, and I'm a 24-year-old real estate investor and attorney. And on this channel, I cover a variety of topics as they have to do with real estate, investing, and personal finance. So if you like that sort of content, be sure to have a look around the channel, and if you like what you see, be sure to subscribe. Anyways, private mortgage insurance, or PMI for short, what is it? Well, it's basically an extra payment that your lender will force you to make if you don't come in with enough of a down payment. Generally, some amount of PMI will be charged whenever you make a down payment of less than 20% of the purchase price. So if you only use 5% down, like I did in my case, then I'm going to have to pay private mortgage insurance at least until I reach 20% loan to value on the actual purchase price. It also is directly linked to your actual loan balance at the start of buying the property. So if you have a bigger loan, you're going to expect a bigger PMI payment versus a smaller loan will have a smaller one. It's directly proportional. But it will also depend on your specific loan product and your lender. So it's definitely worth talking to a loan officer to figure out what that PMI payment will probably be, depending on whatever loan you're trying to get. But generally, PMI payments for the year will end up totaling about 0.3% up to 1% of the actual loan balance, so they can get pretty substantial. In my case, I used a conventional mortgage, and because I'm going to be owner-occupying the property, I only had to bring 5% down to the table. That was as low as I could possibly go, versus 20% for a non-owner-occupied loan for most rental properties. But in that case, you're not going to have to worry about PMI anyways. Really, PMI only applies to those loans that allow you to bring less than 20% down to the table, so really that's only owner-occupied loans anyways. The property I recently bought in Chicago, by the way, I'll include a breakdown on that deal in the description below if you want to check that out. And I got a mortgage for $270,750. That was my total mortgage amount going in. That's with a 5% down payment. I only need to bring about 14 grand to the table. So really not a lot of money in the grand scheme of things, considering I'm controlling about a $300,000 piece of real estate. But if we multiply that $270,750 times 0.3%, that leaves me with $812 in annual PMI payments. And if we divide that by 12, that's the monthly amount of about $68 per month. Now, some people might draw the line there and they'd say, I don't want to pay the extra $68 per month. I want to get rid of that as soon as possible. I want more cash flow. I want less debt payments to worry about. Whatever the case, they often draw the line right there. They want to avoid PMI at all costs. But look at what that PMI payment is really getting me. Like I said, I only brought 5% down to the table, which was just over $14,000 in down payment. In fact, the exact number was $14,250. And because I only brought 5% down, I have to pay that extra $68 per month until I reach 20% loan to value. I'll get to that drop off in a second. But compare that to bringing 20% down to the table, which would be $57,000. So $57,000 compared to about $14,000. We're 4xing the down payment, and thus my return's going to be a lot less because this loan was only 2.99% interest before you factor in the PMI, which would really work like an interest rate boost. But the point is that not only makes it much harder to actually get into the deal because you have to bring so much more money to the table, but that also dramatically changes the actual position of the deal. It goes from a high leverage, high return type position into a low leverage, low return, or low risk, low reward. So it's a very different deal when you have to do that. And again, that's after you have to bring 4 times the amount of money just to get rid of that $68 per month in PMI, and your loan payment would be lower as well, but you also have more money tied up in the deal, and that's risk in itself. Now, I'm not saying that that strategy is not valid, but do keep in mind, if all you're trying to do is eliminate the $68 per month in extra PMI payment, you are going to have to fork over way more money to the table, and it's going to very much change the deal. And frankly, if a deal hinges on $68 per month, it probably isn't worth going through with it. Now, it depends, of course, on what you're trying to do with it. But if we're talking about a cash flow strategy or a strategy where you have a decent margin of error, if rent pulls back $100 or $200 and you're going to have to weather that storm, you'd be able to because you got the property at a good enough price given those metrics. Now, if we're talking about a $68 PMI payment, that's not a lot of money. Or if it's a smaller property, that PMI payment might be even smaller at $50 or $40 per month, or maybe higher. It totally depends on the actual loan product. But the point is, if a property hinges on that PMI payment, it probably isn't worth going through with the deal. And again, in my case, that would be 4xing my down payment to actually reduce my PMI payment by $68. And of course, the loan payment would be lower as well, but I'd be losing out on that super low interest rate financing, which I'd like to take advantage of. But in any event, for most loan products, PMI eventually drops off anyways, and that's when you reach 20% loan to value based on the actual purchase price. So it's not based on the actual property value, but it can be if you go through some extra steps. Now, there are some loan products that won't actually let you remove PMI payments. For example, some of the FHA products, if you bring less than 10% down, I think depending on the loan amount, sometimes the actual PMI payment will not be removed. So again, talk with a loan officer to figure out what the characteristics of the PMI payment are for that loan product, since they can be quite different. But typically, what's going to happen is you can actually remove the PMI payment over time. And that usually happens once you reach that magic 20% loan to value based on the purchase price. So if you started with 5% down, that would mean that you'd have to get up to what would have been 20% down based on that initial loan purchase value. So in my case, I would need to pay down the loan enough to where I would make up for the difference between the $57,000 payment and the $14,000 down payment. That's the amount of equity I would need to build just through principal pay down. We're not talking about forced appreciation. But let's say you bought a property that needed some work and you were actually able to force appreciation on the property. So now it's worth much more than what you initially bought it for. Or conversely, the market has greatly appreciated in the meantime, and your property again is worth much more than your actual purchase price, and you haven't added any new debt to the actual property. In that case, you can still get rid of PMI without actually having to make the extra payments to reduce your loan balance. You can actually tell the lender, hey, the property is worth a lot more than it was before. Can we go through with a new appraisal? And we can get your clearance to say, yes, it is worth much more than it was before, and now I do have 20% equity in the property. That is something you can do. There's typically a pretty rigid process for doing that, but typically it's as simple as reaching out to your lender and asking them for an appraisal to actually go through with getting rid of the PMI. Again, talk to a loan officer on how that would work. So again, is it worth trying to hoard a much larger down payment in the effort to get rid of a $68 PMI payment or whatever it is, even if it's quite a bit higher than that? Is it really worth 4xing or even more on your down payment just to get rid of that PMI payment? I think the answer in most cases will be no, it's not, because if you can get into a great deal and have to pay that little bit of extra premium just so you can kind of look at it like and boost in your interest rate, like I mentioned before, if that's all you have to do in order to get your hands on a great deal, then it's still a great deal, so you might as well get it. And this time, your capital won't be as locked up, so you can go for more deals more quickly versus actually having to save up that massive down payment and put it towards the one property. Now, there's the added benefit of the actual loan payment being much lower, but if you're trying to build a portfolio quickly, leverage is going to be pretty key. Granted, you have to be very careful with any amount of debt, since adding more debt, even via a little PMI payment, that is added risk, since it's more payment that you have to make, even if the property goes south and you're unable to rent it at some point if you decide to move out of that property, which is what I plan on doing with this property. I'll live in it for about a year because that's what the loan says I have to live in it for. And then I'd like to do this again, rinse and repeat, and buy another property using some great financing terms with low down payments, even if it means I have to pay a little bit of extra PMI. So is PMI the end of the world? Well, if it is, then the deal probably isn't very good. But if it isn't, which it probably isn't in most cases with a decent deal, then you might as well go through with it if you understand the risks associated with that debt. The difference between a 5% down payment and a 20% down payment is very large, especially in more expensive markets, so weigh your options carefully. Anyways, that's all I've got for today, so if you like this video, please like it, since that would help the channel out a lot. Definitely let me know your thoughts on PMI and just using low down payment loans on real estate in general. Definitely let me know in the comments below. And if you like this sort of content about real estate investing or just investing in general and personal finance, I have lots of content I put out every single week about those topics, so be sure to subscribe so you don't miss any new videos. And check out the free stuff in the affiliate links in the description below. But until next time, take care.